Welcome back. Well, the markets have bounced off the low point of the day. You have your reference point for the day, 17,825. Well, that's going to be the crucial zone. Earlier, the call today was buy closer to around the 17,800 odd mark. You got the intraday dip, and that's working out at least as of now because you're on the verge of moving into the green. But let's talk to another corporate, PSP Projects. They won an order of around 1,300 crore rupees in Gujarat to construct a high-rise office building. With this, PSP Projects, it has exceeded the FY23 order inflow of close to around 2,500 crores. To understand this particular order, when does it reflect into business, and also the outlook from here on, we're joined by Mr. P.S. Patel, the Chairman and MD and CEO of the company. Hi, Mr. Patel. Good morning. Thanks so much for joining in. Well, it's a rather large order that you won. Could you tell us when does it start reflecting in terms of financials, revenue recognition for this particular order, and also what kind of margins will you enjoy on it?
This order is, we have just received the LOA, but probably 1.5 months or not year, we'll get the final work order and the agreement. So probably the revenue generation for this project will start somewhere in the first quarter of March, after March 23. And the margins which we always consider are the same, whatever we have been bidding since now. So the project margin will not be different than what we are getting now.
Okay. So can you tell us what is the revised order inflow guidance for the rest of the year? What are you looking at?
Yeah, previously we thought of, because of, I usually take it as 25% more than what revenue we are planning. So we give a projection of 2,500 crore, but we have already reached to 3,293 or about 3,300 crore. Still, there is one L1 order which I am expecting to get work order by next 10 days or so. And further also we have some bid pipeline. So probably this year we should reach to 4,000.
Okay, so 4,000 crores is what you'll reach this year. Then in FY24, do you have any kind of visibility on what orders could come through, and what could the growth be for FY24 orders?
See, FY24, again the same scenario. Presently also, what I personally see is the economical investment from the corporates, as the real estate, as the government is coming up with so high. So probably the orders which we have concluded till now, all the orders are from Gujarat. Still, there are plenty of projects which have been announced in Gujarat from the government level and at the private level also. If you see the investment announced by ArcelorMittal, where we are working, Adani Energy, where we are working, Reliance Energy, where we are working. So probably we should be in the same range, at least minimum next year.
Okay, all right. Mr. Patel, you said this Surat order will start reflecting post-March 23. In FY24, how much of it will be recognized in your books?
See, this is about 1340. See, this is about 1344 crore to be completed in 36 months. So probably 350 to 400 crore should be reflected next year.
All right, completed. Okay. All right. And Mr. Patel, then for FY24, what kind of a revenue outlook do you have, given that, you'll be getting a bit of a tailwind from this particular order, 350 crores odd? What kind of a revenue growth are you looking at? And you said that this order will enjoy the similar margins that you're currently enjoying. I'm just looking at your past few quarters. You've been in the vicinity of around 11 to around 14%. For this order, I mean, what should that number be? So revenue growth for FY24 and rough margins as well.
So revenue growth will be in the range of 20 to 25%, whatever we have been doing till now. So we, since we have projected this year revenue about 2,100 to 2,200, so probably adding up this order and at least the projection which we have given of 2,500 crore and reaching an order book of 4,000 crore, we should be able to make revenue growth of more than 25% next year.
More than what? I missed that number. 25 or 35% for next year?
Yeah.
Revenue growth of what? 25% or 35%?
25 to 35% because we
25 to 35. Got it. And what about margins? What should it be if you could
margins? Actually, see, margin will remain on the same line as I always say. It is on the tendering basis and on the selection basis. When we put for a tender, we only bid when the competition is niche, and if we are not compromised anywhere on the margin, And when the qualifying criteria are high and only few companies getting qualified, we being a smaller company, still we are able to maintain our overheads. So we are able to be competitive to other larger companies in construction. So we are really able to maintain the same margin. What we
So
have.
looking out for a number, sir. We're looking out for a number. 12 to
Yeah, it will be,
13%?
yeah, 11 to 13, 11 to 12, 12.5, something like that.
Okay, so 11 to 12.5% is the broad range that you're working with a growth of around 25 to around 35% for next year. Got that.
Yeah.
Also, if you could tell us, how is your balance sheet looking like? Because executing orders is good news, winning orders is good news. But what is your balance sheet looking like, and will you have to raise some debt?
No, actually, we are still able to maintain our working capital within the net accruals, and whatever the exposures which we have from the banks, we are still having a free FD of about more than 150 to 200 crore. So probably there won't be any requirement of debt.
Okay, and as of now, what's the debt status? You have no debt on your books?
No, presently we have not too much long-term debt. So I think there is a short-term debt of about 80
Short-term debt of how much?
80 to 100 crore.
80 to 100 crores. All right. And you also have an FD, I think, is what you said against that.
Yeah. It's about 200 crore.
Okay. All right. Also, give us a sense about, some new orders that were likely to come in from the Parliament in Delhi. Could you tell us, a quick status update on that?
Yeah, because till now we were not getting qualified, but the last project which have been announced is MP offices, which was first came up as 1450, and then again the tender has been revised to 1250, and this is a pre-qualification bid, so we are going to bid for that project, and probably that bid of pre-qualification will go in next week.
All right, sir, thank you very much for your time. Good speaking with you, and all the best for your plans going forward. The market is absolutely flat now, just 12 points lower. So it's a very strong, decent pullback that we have on our hands at 17,900 now. Now, as promised, our special segment, Quarter Se Quarter Tak, we look at sectoral expectations every day, different sectors. Sonia has walked across to the big wall, and she's going to take us through the expectation from the auto sector for the third quarter. Sonia, over to you.
Well, let's talk about what to expect this quarter from the auto sector, right? The demand environment is stable across most segments post the festive season. Revenue growth is expected to slow down in a couple of pockets like the two-wheeler sector, while the medium and heavy commercial vehicle sector growth is expected to be strong. Now, Maruti and M&M are expected to report a revenue growth of anywhere between 20 to 40%, as you can see on this screen, while commercial vehicle players like Ashok Leyland are expected to report a very strong 61% growth in this quarter gone by on a year-on-year basis. The laggards, as we all know, are two-wheeler makers like Hero and Bajaj Auto that have been hit due to no recovery in the rural demand and a slowdown in the export market. So look at that. Hero barely a 1% growth in the revenues, while Bajaj could see a fall of 3%. Now, the big question is, as pent-up demand normalizes, will growth rates slow down further? Nomura put out a report where they expect the passenger vehicle industry growth to slow down to 6% in FY24 from 23% in FY23. Remember, regulatory costs are also rising because of the BS6 Phase 3 norms that kick in April 2023 onwards, and 6 airbags will be compulsory from October of 2023. So the question is, will higher regulatory costs hit demand further? Another ponderable is, will discounts continue to increase across segments like commercial vehicles, or was it just a year-end phenomenon? And finally, will there be any respite in export demand for two-wheeler players? Export demand, remember, continues to get impacted by the availability and devaluation of forex in the end markets. Let's take a look at the volume table below. Companies like Ashok Leyland and M&M are expected to see the highest volume growth year on year. And, if you move down, you take a look at some of the other players like Hero MotoCorp that could see a fall in volumes. Now, that's on the top line front. Let's move to margins. Margins is the positive picture. It will improve for the second quarter in a row, led by lower commodity costs. The commodity cost index itself is down 250 to 300 basis points compared with June 2022 levels. Lower commodity costs along with price hikes of 1 to 2% should benefit margins in both Q3 and Q4. Take a look at the table that comes up for you in a bit. Ashok Leyland and Tata Motors along with M&M will see the biggest margin recovery this time around. And we, of course, await commentary from managements with respect to whether there is scope to improve margins further, given lower raw material costs and operating leverage. And finally, we will seek data to conclude whether we are at the end of the auto down cycle, as demand is largely stable post the festive season and margins are expected to improve. So let's head across to Basudev Banerjee, who is the analyst at ICICI Securities. He joins us now. Basu, thanks a lot for joining in. As I was, just speaking about it, margins are expected to recover and volumes, barring two-wheelers, are expected to be stable post the festive season. Your thoughts on the three key expectations from the auto sector and the stocks that you like?
Yeah, so few things which you pointed out rightly, like the commodity basket is down to 50 basis points, which should help the margin structure. But firstly, I won't look at the growth from a year-on-year perspective, because the segments which have grown on a year-on-year basis, the stock prices have also run up subsequently. It is all about the sequential volume movement and margin outlook, which will drive the price and the forward business outlook. So from that angle, if you look at the two-wheelers where volumes were down mid-teens on a sequential basis, that will balance out the benefit of raw mat decline. So from that aspect, this quarter, we expect two-wheelers to report a weak set of numbers. And as you rightly mentioned, if you look at the stock prices of two-wheelers also, they have been laggards. So you can say that the weak results are already built into the price, and that's why stocks have corrected or gone nowhere. Correspondingly, from a result perspective, the number which you showed on the screen for Tata Motors India business margin, which is 10.6%, if that comes from 6% last quarter, it will be a big positive surprise. We don't expect such a major jump on a sequential basis. 6% can become 8.5%, 10% plus doable in Q4, where seasonally it's the strongest quarter in terms of volume. So yes, we are most positive on the commercial vehicle space, where price hike retention ratio is at a 70 to 80% level compared to 20-30% in the previous upcycle. So that means if you are hiking prices by 1,000 rupees, your effective price hike is almost 700-800 rupees. So that is quite a positive signal, and we are already halfway through the CV upcycle. So it's now the turn of margin improvement for the CV players. Volume growth has been stupendously strong. So yeah, from this quarter onwards, margin improvement for CV players will be the key driver from a stock price perspective. For passenger cars, as you rightly pointed out, 20% plus growth anyways is not sustainable. And the good part is, if you look at 20% growth was on the background of 12 to 15% blended price hikes to pass on the commodity inflation. Next year, the BS6 phase 2 or the airbags price hikes won't be of that extent. So despite lower price hikes, fuel costs being subdued, still because of base effect and consolidation, industry growth should normalize down. But volume growth should not be the right parameter. One should look at the value mix for the industry also.
So within the two-wheeler space, I do know that, of course, it's expected to be a weak set this time, but you like TVS Motor. There's also that added benefit for TVS Motor. It's doing exceptionally well in the EV space, although it's a very small portion of the business. But do you think this electrification theme is something that could play out in this year? Will these companies like TVS, maybe even Tata Motors, Maruti, of course, is some time away, M&M, will they see an outperformance because of the electrification theme?
So frankly, outperformance because of EV theme, I don't think is going to happen immediately. It is more to do with the losses in the EV space narrowing down with volume scaling up. So for example, TVS has already reached almost 12,000 units a month. So the more they scale up in the EV space, their EBITDA per unit losses will shrink further and help overall margin to move up. So just EV, first mover advantage in EV helping them to outperform at least in next 12 months, I don't think that's going to happen. But for this quarter results, even TVS, I don't think is going to report any great set of numbers. But we like TVS from a long-term perspective.
You also like Ashok Leyland, and that has been, the numbers are expected to be good. It's been an outperformer. How much more upside do you see here, and what could be the triggers this year or this quarter?
They're building in fiscal 25 as the peak of the CV cycle. And as you know, Leyland trades at somewhere around 12, 13 times EV EBITDA at the peak of the cycle. So somewhere around further 40% upside from today's level, I'll say that it will peak out from this business cycle perspective. So next trigger will be margin moving up from this 6-7% to upcycle margin of 10%, and that is the next big move to look for in the stock.
Okay, happy to chat with you today. Thanks a lot, Basu, for joining in. Have a great day. That's the word coming in on the auto sector. The market, by the way, is so very quiet. Is it the lull before the storm? You never know. But for now, after yesterday's big fall, the market at least has not seen any accelerated pressure, and neither has it seen any revival, just consolidating around the 17,900 mark. In fact, we'll pose that question to our technical expert, Mitesh Thakkar, will be joining in for a technical trade in just a bit.
Okay, we're back in the green, 14 or 15 points higher on the Nifty. The sell-off is all but, memory of the last 1 hour or so. It's still early days. I mean, the market's been trading for 45 minutes, but at least, that initial first dip has been kind of bought into. Now, let's hope we at least hold these levels, if not build on them. And actually, no reason why the market can't build on a little bit more. Given the fact that there is nothing untoward happening in terms of the global setup or anything of that sort. Earnings, of course, will continue to come through, and there will be that to impact stocks and sectors, etc. TCS, of course, has kicked it off. But otherwise, I mean, it's not a terrible looking picture, global picture or otherwise, that one is responding to. Nigel.
Just want to point out the Nifty Bank. The last 3-4 sessions been a big underperformer. Today, the Nifty Bank is the outperformer. Just pull up the Nifty Bank out there. It's up 0.3%. The Nifty has barely moved into the green. And I think HDFC Bank, that's the one in there that's fighting for the bulls. So has the Nifty Bank given up that recent underperformance? Can it have a bit of a field day? That's going to be important because the Nifty needs to move up. Then the Nifty Bank either needs to consolidate and not underperform. And that's precisely what's happening. It's outperforming as we speak. Mitesh Thakkar is back with us. Mitesh, the hint earlier this morning was if you get a dip, you buy into it. The FIs are net short. The data is looking a little bit bearish. Maybe buying the dip could work out. It's worked out for now. Do you think it has more legs?
So my sense is, Nigel, that 17,800, 820 remains a zone which is being retested time and again, and we're not breaking below that. So, I think shorting one should be done below that. The bounce back could always happen. The first time we got a bounce back, which was in last week of December, we got up to about 18,250, and last time we got up to about 18,150. So till we cross 18,150, I don't think I'll trust the bounce back to change the trend on the upside. But I think, yes, till that level gets violated, I think just hold your horses on going short aggressively and try to short close at about 18,150. Having said that, I have one buy and one sell call. eClerx is something which has turned very positive in the last 2 days. Yesterday also did well in a falling market. So that's a buy with a stop below 1330 for targets of 1425 on the upside. And Apollo Hospital is a stock which is negative, and yesterday gave a pullback, is breaking down today. So that's a sell. Keep a stop just above levels of 44.40 here. Look for targets of 43.20 on the downside.
Okay. Thanks a lot for that. Well, let's shift focus now to the commodity markets. Manisha Gupta is joining in. Manisha, what are you looking at this morning?
I'm absolutely looking at copper because what a start to 2023 in this commodity. Whether you look at LME, Shanghai, US markets, we are looking at copper prices trading at a 6-month highs across all of these exchanges. When you look at LME itself, we are looking at a resistance at $8,900 per ton there. But on US markets, we've crossed above $4 per pound yet again in the markets there. Well, if you look at the global smelting in sense of copper for 2022, that was the lowest in 6 years, and that has been supportive. And then apart from that, when you look at the overall output output for copper, whether in Chile or Peru, it has been quite low. There is political unrest there, and that has impacted the mine output there. If you look at the Chile output itself, we have seen a decline in the month of November, overall by 6.9%. And the major miners like Codelco, BHP and Collahuasi, you can see anywhere between 1 to 12% of a decline for the last year in sense of copper production there. Markets also are looking at the China Zhangzhou plan, where they are looking at starting or restarting 1722 projects, which are worth $945 billion in the year 2023. And that would mean you would require more steel, more construction material and copper, and that is supportive. The China Lunar New Year holidays for the month of Jan starts between 23rd to 27th of Jan, and the expectation is that we are looking at some restocking ahead of that as well. This is what copper has done over the last few years there, and while there was a dip in 2022 in sense of prices, 19, 20 and 21 saw some gains, and this year so far in the first 10 days of the 2023, we are up by nearly 4.5% already, so 6-month highs on your screens there. If you look at the global markets as well, there is just about 4.5 to 5 days of global consumption worth of inventories in the markets, and that is supportive. This is the outlook where Goldman Sachs expects new all-time highs in case of copper in this year at 11,000. They are expecting higher highs in 2024 going forward as well. And the average that they're looking at for this year is 9,750. We are trading at around 8,900 right now. Bank of America also expects all-time highs in case of copper in this year by third quarter, that is. But Fitch, BNP Paribas and GN City are expecting an average of where the copper prices are trading right now. Fitch actually expects the copper prices to decline, but many of these banks and brokerages also believe that the first half could be difficult for the industrial metals and copper included. But second half, third quarter and fourth quarter is where you could be looking at demand coming back, China reopening properly, interest rate highs peaking, and that is where you would see support coming.
Manisha, thank you very much for that. By the way, we've got a China discussion coming up a little later after a quick commercial break. But before we do that, Bharti is the one which is slipping in trade. Actually, it's been the top loser since we started. Nimesh is here. He highlighted Bharti as the standout brokerage report. This is from JP Morgan. It's a non-consensus call. Nimesh, tell us more.
That's right, and that's the reason why Bharti is the biggest loser today. As JP Morgan has today downgraded the stock to underweight from overweight, and they've sharply cut the target price to 710 versus 860 earlier. Now, three specific reasons why why JP Morgan has downgraded Bharti Airtel today. One, higher than expected capex. Two, delayed price repair. And three, lack of 5G monetization. In fact, JP Morgan believes that Jio's focus on high-end consumers would mean that there is a higher capex for Bharti Airtel to defend the market share, and competitive pricing in 5G would delay the free cash flow and return on invested capital. Now, at the current market price, JP Morgan believes that the stock is baking in a modest FY24 estimated capex, 10% tariff hike, and a continued ROIC expansion. All three looks difficult in the current environment, and hence a big downgrade on Bharti Airtel to underweight from overweight, and they've sharply cut the target price now to 710.
Okay, thanks for pointing that out and flagging it off for us, Nimesh. Well, Bharat Dynamics is buzzing in trade. The company is a beneficiary of the Defence Acquisition Council's nod for acquisition proposals worth 4,276 crores. Vahishta is joining in with details. Vahishta, over to you.
Hi, Sonia. Thanks for that. Well, as you mentioned, the defence stocks are actually going to be in focus today. And this is, just like you mentioned, the Defence Acquisition Council has approved the acceptance of necessity for 3 capital acquisition proposals, which totally sums to 4,300 crores approximately. Now, the 3 proposals include 2 for the Indian Army and 1 is for the Indian Navy. Now, this includes the procurement of Helena anti-tank guided missiles, launchers and associated support equipment, which will be integrated to the Advanced Light Helicopter. Also, there is a procurement of IR homing missile system under the design and development by the Defence Research and the Development Organization. Now, these new developments are expected to be beneficial for Bharat Dynamics, which is a prominent player in the aerospace and defence industry. Back to you.
All right. Thank you very much, Vahishta, for that. We'll take a break here with news. Good news that the Nifty is up 40 points. So far, so good. 17,950. We take a break. On the other side, we have a discussion lined up on the China reopening and the impact on asset prices and, of course, macros. So we have 2 very special guests joining us on the other side. Stay with us. Okay, welcome back. The markets picked up from the day's low, at least the first hour low, and that is good news, as we've been pointing out. Well, China reopening is the big theme, right? I mean, especially from an Indian perspective, because all of last year we've heard how China is kind of out of the game because of these rolling lockdowns that they've been facing, and how that is an advantage for major economies like India. But does the China reopening introduce major competition for both economic growth and flows as well from a market point of view? To discuss this, we have two very special guests joining us. Matty Becknick is China Director at the Economist Intelligence Corporate Network. Matty, great to have you with us here. Thank you very much. Jinjin Lee is Managing Director at the Observatory Group. Mr. Lee, good to have you with us here on the program. I believe you're staying up late for this. Thank you so much for doing that. Appreciate it. Matty, let's just start with what's happening on the ground in China in your in your perspective. Is this a hard, very sudden, dramatic reopening here to stay? And how would you rate it in terms of how dramatic and how aggressive this is as compared to what you expected?
With you, and it has been more dramatic and more unexpected than anyone could have forecast or imagined. Here on the ground, sometimes people describe it as a V turn rather than a U turn because it was so absolutely sudden. I think it's important to remember that just a few short weeks or even the week prior to the transition and kind of the abandonment of zero COVID restrictions, the state media was still speaking about the controls of the virus as the all-out people's war against the COVID virus, and that there was a real emphasis on sticking the course even after the 20th Party Congress and into November. And so the sudden shift was quite unanticipated. And we've gone in China from having some of the strictest restrictions anywhere in the world related to COVID to having basically nothing in a matter of weeks. It's also a COVID naive population because we haven't had anything akin to a major outbreak that was across the entire nation until now. So it's been a challenging time. I think to your comment opening this conversation, though, the zero COVID policy in China has really had a chokehold on China's economy in 2022. It worked very effectively for the first 2 years, but since the Omicron transition, the need for increasingly restrictive controls and lockdowns has stomped on consumer and investor confidence. And that's why this reopening is so important in terms of economic news and recovery as we head into the new year, or we are in the new year, excuse me.
Absolutely. Mr. Lee, what about you? What are your thoughts on the reopening in China? I'm sure the transition must be challenging as well, right? From this zero COVID policy straight to a complete reopening. What do you see as the way forward now? And what are you penciling in terms of growth projections?
Well, I think China's reopening is one of the most dramatic shifts in the past few years in this global pandemic. China is the first country gets into the COVID, and now is the last country getting out. But the way China is exiting from the pandemic is quite dramatic. And over the past few weeks, there have been a dramatic shift by Chinese policymakers on several fronts. Not only zero COVID policy, but also the regulation on the private sector, including the housing market, and even China's foreign policy. I think this is a combination of the policy shift after Xi's third term started in China. And more importantly, there is a very strong policy intention, which is pro-growth and pro-business at this moment. The backdrop of this policy shift is that there is a rising public anger. There's a very negative public opinion against the zero COVID policy. There's also a very dramatic cost of zero COVID policy, this lockdown and the economy. It's estimated that over the past 3 years, the zero COVID policy has cost China at least 2 percentage points of GDP growth per year. And also there's a changing external environment. In the past 3 years, China's export growth was doing relatively well, which contribute about 1.3 to 1.4% of GDP growth over the past 3 years. But in the second half of last year, China's export growth was cooling down very fast. And in July, the export growth was 18% year-on-year. Positive, but in November that number was negative 8% growth year-on-year. suggesting that the external demand for Chinese goods was cooling down very rapidly. Against this backdrop, this zero COVID policy probably is unsustainable. I think that's the most important reason behind this dramatic shift of zero COVID policy. Looking forward, we believe there is a headwind. There is also a tailwind, and also an uncertainty in the economic process. The growth projection for 2023. The economic, the tailwind is clearly from this reopening. I think in the current stage, the reopening is the best economic stimulus to Chinese economy. It's better than any other policy stimulus, including monetary easing and the fiscal stimulus. It will unleash this pent-up demand from the Chinese households for the consumption, and also especially we are already in this Chinese New Year time. The travel levels during the Chinese New Year is a very important indicator to measure this pent-up demand and its recovery. And another thing is that we are going to have this negative contribution of the export growth to GDP. This year. So this is a clear headwind for Chinese economy. And the third point is this deregulation trend in China over quite a wide range of private sectors, including housing sector, including the private tutoring companies, and also the internet-based service companies, including Alibaba, Tencent, Didi, you name it. And so I think if we put this together, there is a chance that China can achieve the growth target set by this government at 5%. But there's a lot of uncertainties down the road. For example,
no, that's very Mr. Lee. Just coming back to you, but very well put. I mean, all of it together, Matty. So as you said, this is not a U-turn. This is a V-turn, as many of you said were describing it. But this is not just about the COVID zero COVID policy, right? As Mr. Lee mentioned, it's about excessive regulation, going after internet platform companies, very aggressive foreign policy stance. Are we going to see a bit of a U-turn or V-turn on all those aspects as well? Because I would assume it was the cumulative effect of all of it which put off foreign investors in a very big way. Your sense?
I think that's correct. 2023 will be a year of change and challenge for China for some of the reasons that you've mentioned. We're also seeing a third Xi administration, and I think the big question will be whether this new administration will undertake the economic reforms and structural reforms necessary to ensure China's long-term competitiveness, or some of the lingering and pressing short-term issues like the property sector, like the transition out of zero COVID, which yes has stoked optimism, but will certainly be a bumpy road moving forward. Will that kind of distract from that agenda? But with the third term secured, you're already seeing certainly that the new administration or the incoming administration is focused on shaping the economy and the society that China wants for the future. It's very clear that growth and development is a top priority, but balanced with concerns about national security and social fairness. So I do expect that we'll see further policy shifts that are aligned with that longer-term vision for China.
So, Matty, is it fair to assume that large foreign investors could be hesitant to put big chunks of money into a market like China purely because of the flip-flop in terms of policy that we've seen, at least over the past 2 years?
So one thing that we saw in 2022 was that a lot of foreign investors, and this includes MNC and other kinds of investors, hit the pause button on investment plans in China because of the uncertainty in the market related to zero COVID, some of the other kind of more broad issues around geopolitical tensions, supply chain concerns, the longer term conversation around decoupling. So one thing we are forecasting within the Economist Intelligence Unit is that we'll see a softening of the FDI differential between China and kind of ASEAN or Southeast Asian nations in the coming 5-year period. As you alluded to in the kind of the opening comments, this is also somewhere where there's a question of whether India might stand to benefit from this, of course. However, the Chinese market is simply too attractive and kind of too central in the global economy and in global supply chains for investors to kind of back away from entirely. And I think this kind of final signal, despite the kind of uncertainty and the bumpiness that we're experiencing now with pressures on the healthcare system and surging infections, et cetera, that will at some point even out. And I do expect that we'll see kind of a renewed interest or kind of a resumption of interest in the China market.
All right. Lady and gentlemen, we will leave it at that. Thanks a lot for stopping by, and thank you for waiting so late, Mr. Lee, for us. Thanks for speaking to CNBC-TV18. Well, that's what you can expect from China. For the market, by the way, we have seen a bit of a recovery, so that's good for the bulls. The Nifty is back above 17,960. It's been a tight range for the market between 17,900 and 18,200, so we are within that range. But at least today, after yesterday's deep sell-off, there is a tad bit of recovery that you're seeing on the market. From Prashant, Nigel, myself and the entire team, thanks a lot for watching Bazaar. Lots of trading ideas lined up on Chartbusters next.